Bienvenidas y bienvenidos al segundo panel que se titula Políticas monetarias y financieras, estabilidad macroeconómica y desarrollo. Y tendrá como eje el rol de las políticas monetarias y financieras en fomentar el desarrollo económico, la estabilidad macro y la inclusión social. Contaremos en este panel con las exposiciones de Claudio Borio, jefe del Departamento Monetario y Económico del Banco de Pagos Internacionales, BIS, Stephany Griffith-Jones, profesora emérita del Institute of Development Studies de la Universidad de Sussex, y Annina Kaltenbrunner, profesora de la Escuela de Negocios de la Universidad de Leeds.
Mi nombre es Germán Feldman, soy economista jefe del Banco, y me acompaña en esta actividad Jorge Carrera, vicepresidente segundo del BCR. Esta presentación estará a cargo de Claudio Borio, del BIS. Claudio fue nombrado jefe del Departamento Monetario y Económico del BIS en noviembre del 2013. Desde 1987 ha ocupado diversos cargos en la institución. Entre 1985 y 1987 se desempeñó como economista en la OCDE, donde trabajó en el Departamento de Economía y Estadística. Anteriormente fue profesor e investigador en el Brasenose College de la Universidad de Oxford. Tiene un doctorado, una maestría en Economía y una licenciatura en Política, Filosofía y Economía de la misma universidad. Es autor de numerosas publicaciones en las áreas de política monetaria, banca, finanzas y temas relacionados con la estabilidad financiera. So, Claudio, the floor is yours.
Well, thank you very much. And first of all, let me thank the organizers for their very kind invitation. It's clearly a pleasure for me to be here, and particularly given that I grew up in Argentina, although I'm Italian, so it's always great for me to be back, although on this occasion, unfortunately, just through video. So I was asked to deal with the issue of the relationship between monetary policy and inequality. And in order to do that, I will be drawing on the BIS annual economic report, which came out in June. So I would strongly encourage you to read it. Why is the question relevant now? Well, we know that the inequality has been rising for many years across the world. That is one reason. But the second reason, which I think is much more specific to monetary policy, is the fact that since the great financial crisis, central banks have had to keep interest rates low for very long, in fact, very low for very long, the low for long phenomenon. And that has created the perception that by doing so, they have been raising the prices of assets, particularly of equities. And through that, they have been increasing inequality at the top. And by reducing the rates on deposits, in fact, here in Switzerland, they are actually negative. They have been making the poor poorer because, of course, we know that the people that are poor tend to have a lot of their wealth in deposits. And the COVID crisis has simply increased the attention on this issue. Indeed, if you look at this graph that shows the times that the word inequality and monetary policy comes up in central bank speeches, you will see that there has been a huge increase since roughly 2008, 2009. You will also notice, by the way, that the increase has been greater in advanced economies, and I'll come back to that later on. Now, in fact, a lot of what I will be saying applies also to emerging market economies, but there are some aspects that are really very much about advanced economies. Now, we reach effectively three conclusions. First, we reaffirm that fundamentally, long-term trends in inequality are not a monetary policy phenomenon. They're driven by structural factors which are beyond monetary policy's reach. Second, despite all that, there is a lot that monetary policy can do in order to promote a more equitable society. But that's only over business cycles. And this is because price, macroeconomic, and therefore also financial stability are key in order to ensure that inequality doesn't increase. And this is really what monetary policy mandates are all about. And third, and this applies to a number of countries, but not generally, fundamental changes in the business cycle have complicated this task. and hence the impact of monetary policy on inequality. As a result of this, it is essential that other policies play a complementary role, and here I'm referring in particular to prudential, fiscal, but also structural policies. So let me take each of these 3 points in turn and start with the factors behind structural trends in inequality. Well, first of all, as I said before, inequality within countries has been rising since the early 1980s in both advanced and emerging market economies. You can see this in the red line and the blue lines respectively. You will also see, though, that in emerging market economies, the trend has not been as pronounced. Now, while inequality within countries has increased, inequality across countries has actually come down. And this is something which is very important because it means in particular that the factors that have led to inequality within countries have been actually beneficial for the world as a whole, and in particular for emerging market economies. And you can see this in this slide. The blue line shows what's happened to poverty across the world, and the red line shows that inequality across countries has declined. Now, long-term structural developments necessarily have structural causes. And two that we highlight in the annual economic report, they're not the only ones, are technology and globalization. Technology has increased, technological advances have increased inequality by raising the demand for highly skilled workers at the expense of lower skilled workers. And globalization, by shifting jobs, by effectively displacing a big chunk of workers with the labor force, particularly in advanced economies, as they lost their comparative advantage. We can see in this graph that, roughly speaking, the relationship is there, even if you do a relatively simple analysis. We see that over long periods, there is a clear cross-country correlation, positive correlation, between measures of technology and globalization on the one hand, and income inequality on the other. And this is the left and right-hand panels, respectively. And by the way, whenever I'll be referring to income inequality, I will be talking of inequality measured by the Gini coefficient, which is probably the most standard one. Now, as I said, if structural causes are the main reason behind these long-term trends, then we need structural remedies. Because only structural factors, only structural policies can adequately address inequality. Because they can tackle the underlying forces through, for instance, better health, education, antitrust legislation, and more generally, by fostering equal opportunities. Meanwhile, as this graph shows, there is also a role for fiscal policy, because we see that inequality after taxes and after transfers is lower than inequality before them. That is why that's indicated by the fact that the red bars are higher than the blue bars. Having said all this, there is also a role for central banks wearing their non-monetary hats, because these are functions that are of a more structural nature. And of course, this will depend on the specific responsibilities that central banks have and also on the specific tools at their disposal. Responsibilities and tools have to be aligned. Example of this, as indicated in this little picture, by promoting financial development, inclusion, and financial literacy, central banks can offer the more disadvantaged more, better, and safer savings vehicles. By contributing to financial consumer protection, they can shield them from predatory practices. And by making payment systems more efficient and competitive, they can reduce the cost, especially the cost of cross-border payments, remittances, which disproportionately hit the poor. Now, let me move next to the relationship between inequality and monetary policy mandates more specifically. Having said what I said about the structural forces behind inequality, there is still actually quite a lot that monetary policy can do in order to reduce inequality. This is because the two major sources of inequality over business cycles are inflation and recessions or downturns more generally. And this is what monetary policy mandates are all about. That is, deliver price, macroeconomic, and has also financial stability. Whether we think of financial stability in a very narrow sense as banking crisis or financial crisis, or in a broader sense, which is the one I prefer to think about, which is the amplification that financial factors have on the business cycle. Now, let me consider inflation and recessions in that order. Now, this slide reminds us in a very simple way that inflation tends to increase inequality, and this has been amply studied. I think you all know that inflation is regarded as a regressive tax. Moreover, it has been established that the impact is nonlinear, so that as inflation rises, its impact on inequality rises more than proportionately. And of course, I saw this vividly when I grew up in Argentina, and I could see how the poor were really those that lost most from high inflation. And there are a number of reasons for this. First, they are the first to lose their jobs when inflation erodes the economic fabric of society. They're the first to see the purchasing power of their wages suffer when prices soar. And of course, that they're least able to protect their savings, not least, for example, by putting them abroad. Now, this graph provides some stylized, simple evidence to that effect. It shows what happens to inequality once inflation falls below a threshold of 5% on a sustained basis since the mid-1980s, and these are episodes for emerging market countries only. We see that inequality falls, whether that is true on average, and that's the blue line, which is the median, or more generally, and that's the shaded area, which shows the interquartile range. Now, what about recessions? Well, I think the intuition would tell us that a recession should raise inequality because, of course, the unskilled are the first to become unemployed. This graph confirms that intuition. We see that following recessions, and that's the vertical line, unemployment goes up, that is the red line, and inequality also goes up and more persistently, and that is the blue line. But in fact, the relationship goes further. First of all, there is evidence that all else equal, higher inequality tends to be associated with deeper recessions. And we see this in this graph for a sample of advanced and emerging market economies. We see that as recessions become deeper as we move from lower to higher income inequality countries. That's the red, blue, and yellow bars, respectively. Now, why is this the case? Well, perhaps because a larger proportion of vulnerable workers are in countries where inequality is higher. Now, the second reason is that on balance, higher inequality tends to reduce the power of monetary policy. And this is shown in this graph that portrays the cumulative impact on consumption of a monetary policy easing. We see that the impact declines as we move from countries with lower to higher income inequality. That is, the bars become smaller as we shift to the right. Plausible explanation? Well, we know that richer people have a lower marginal propensity to consume, and we know that poorer people find it harder to borrow once interest rates decline because they're subject to tighter financing or credit constraints. Now, putting these factors together, you can see the possibility of a perverse amplification. On the one hand, recessions tend to increase inequality. On the other hand, higher inequality tends to increase the amplitude of recessions and also to reduce the impact of monetary policy, which makes the task of monetary policy harder. Let me now turn to inequality and monetary policy trade-offs. Now, what the previous analysis indicates is that if monetary policy succeeds in keeping the economy on an even keel in pursuit of its mandate, it will also, by the same token, keep in check the major sources of inequality over business cycles, and that is inflation and recessions. Moreover, by doing so, it will also avoid the intertemporal trade-offs that arise when things go wrong and monetary policy has to bring the economy back on track. This, and when I'm talking about intertemporal trade-offs, what I mean is that there are unwelcome short-term costs that are necessary in order to reap the longer-term, bigger benefits. Now, let me consider inflation and recessions in turn. Bringing inflation under control, we know, will generally cause a recession. The central bank raises interest rates, the economy goes down. Now, this is not necessarily the case everywhere. I mean, in some countries, for example, those that have had exchange rate stabilizations, at least after a while, you can get a boom because foreign capital comes in, and that generates a credit boom actually in the economy. And that actually could have implications and welcome implications later on, as I will be discussing. So, central bank tightens monetary policy, there is a recession, inequality increases in the short run, but this is the inevitable pain which is incurred for the longer term gains in terms of unemployment and in terms of income inequality of non-inflationary growth. Now, in fighting the recessions, on the other hand, the kind of trade-offs are more subtle. Now, in order to fight a recession, the central bank has to keep interest rates low. Now, in this case, as you will see, there is no trade-off between income inequality and monetary policy because employment increases and inequality declines. But there may be a trade-off in terms of as between monetary policy and wealth inequality. And that is because, as I mentioned at the beginning, keeping interest rates low, particularly if you do it for long, will tend to increase wealth inequality. Now, this is not a given. It is possible that that doesn't happen, particularly if, for example, you have countries in which ownership of property, houses, is very dispersed. According to some measures, particularly those that take into account the whole distribution, inequality may not go up. But of course, if you take narrower measures, for example, looking at the very, very top of the distribution, this is unlikely to be the case. And even if wealth inequality as a whole does not increase, we know that house prices, increases in house prices, have their own distributional effects because they benefit those that have them, but they are counterproductive for those that don't. And in particular, this tends to generate some intertemporal, or if you like, intergenerational tensions between the old, that tend to be owners, and the young, who tend to be renters. Now, these trade-offs have always been present, but I will argue that changes in the nature of the business cycle have actually made them worse. Because as inflation has come down, and as we have had financial liberalization across the world, there has been a shift from what we call in the annual economic report, inflation-induced to financial recessions. Or what I call in my writings, financial cycle-induced recessions. Now, this graph tends to illustrate, or tries to illustrate, this particular change in the nature of the business cycle. Now, this is what business cycles tended to look like before 1985. And you will see that there was an increase in inflation, there was a substantial tightening in monetary policy, and that tended to generate a recession. The vertical lines denote the beginning of a recession. By contrast, and this is very important, you will see that nothing much happens to credit. And here, this is measured by the deviation of the credit to GDP ratio from a slow-moving long-term trend. By contrast, since 1985, the nature of the recession has been quite different. We see that very little happens to inflation. As a result, very little happens on the run-up, during the run-up to monetary policy. There is not much of a tightening, but a huge credit expansion turns into a credit contraction, or more generally, a financial cycle boom, if you include also asset prices, particularly property prices, turns into a financial cycle bust. Now, this has had two major consequences for the relationship between monetary policy and financial and inequality. The first is that financial recessions tend to be deeper and longer, especially, but not only if banking crises break out. Now, this is shown in this graph that where you can compare the blue line, which is the impact on unemployment of a financial recession, with the red line, which is the impact on unemployment of the normal standard recession, of a pre-1985 recession, if you like. As a result, central banks have to push interest rates even lower and keep them there for longer. Now, why are financial recessions deeper and longer? I think this has to do with the fact that the economy has to absorb the over-indebtedness that tends to be the legacy of the previous boom, and also the misallocation of capital that tends to occur during the boom, because, for example, the construction sector tends to grow too fast relative to other sectors, and then it has to contract, so that you also have to adjust the real capital stock of the economy, the usage of the real capital stock. Now, the second reason why this creates problems is that with inflation expectations well anchored, and inflation less responsive to economic slack, what people typically call a flat Phillips curve, central banks can have been able to push harder during expansions with little need to raise interest rates. So that has meant that they have increased employment during the expansion further than they would otherwise have, and therefore increased equality or reduced inequality during that phase more than they would otherwise have. So this is good in the short run. But by encouraging risk-taking, by encouraging the buildup of financial imbalances, they can create the ground, they can sow the seeds for a subsequent financial recession further down the road, with all its negative consequences for inequality. The implication of all this is that a more balanced approach is needed. And by that I mean that what we need to do is to put in place a macro financial stability framework that includes in particular prudential policy, both micro and macro prudential policy, fiscal policy, and even structural policy, in order to be able to tame the financial cycle, in order to be able to manage crisis better, and by so doing, alleviating the trade-offs that monetary policy faces, and therefore also reducing inequality on average during business cycles. So let me conclude with the three takeaways that I mentioned at the beginning. First, monetary policy does not have the responsibility or indeed the tools to address the structural factors that impinge on inequality, because structural policies are absolutely essential here. Second, but by pursuing its mandate effectively, monetary policy can do a lot to tame the macroeconomic forces that amplify inequality over business cycles. And by that, I mean effectively inflation, recessions, and of course, the financial instability that can go along with recessions. And finally, and this really applies mostly to advanced economies, but also to a number of emerging market economies, obviously not those that really are still facing inflation as the primary problem, and that is the case of Argentina. Changes in the nature of the business cycle have complicated the task of monetary policy. And because of that, we need a more holistic macrofinancial stability framework in order to improve the trade-offs that monetary policy faces. Thank you very much.
Well, I want to thank Claudio for your participation in these Jornadas Monetarias y Bancarias. I also want to remark that the research department of the BIS has been doing in the last years an extraordinary and challenging work in several fields of international economics. In fact, as a professor, I used several of your papers and regarding the global financial crisis, the level of interest rate at the global world, about the banking group, the saving group, the role of the current account vis-a-vis the capital account, the description of the financial global cycle, the discussion about nationality and residence of debt. So really is an amazing job that you have done at the BIS, and so our congratulations. Regarding the one question of your excellent presentation, seems to be that monetary policy is inefficient to address inequality. It's natural to suggest that pro-equality policy should be financed by fiscal resources, and particularly with the use of progressive tax. The point is to determine how is the external and fiscal space that countries nowadays has in order to implement this kind of policy. Even in countries with a solid and robust fiscal position, the context of international financial and fiscal liberalization and the regulation that we have seen since the 90s make very difficult to implement progressive tax policies. In fact, the question is the tax competition among countries and the possibility of having tax arbitrage and regulatory arbitrage. So if you want to increase progressive tax to the top 1%, maybe they move the residents, and so it's difficult to reach this progressivity of the fiscal system. So how can policymakers do, especially in emerging markets, in order to avoid this limitation? It's possible to think something like a global fiscal cooperation in order to reduce inequality?
Well, thanks. That's definitely a very good question. One can answer it in a different number of ways. And first of all, you're absolutely right. It is very hard to tax people at the top in a globalized world, or at least it's harder than it would be in a world which was probably more closed. But of course, the price to pay in other dimensions it would really be huge. And in particular, you mentioned the progressivity of personal income tax, but of course there is also the issue of taxing corporations and benefits. You know, the income of corporations tends to go mainly to people that are richer. And as you know, in that particular area, there is now a big international effort which is proving successful in order to coordinate corporate taxes across the world. So that's one answer that one can give. The second answer, which I think is important, is that in order to reduce inequality, you can of course operate at the very top, but it's quite important to operate at the bottom, and that is basically transfers. And transfers is what has the biggest impact at the bottom of the distribution. Now, of course, in order to be able to have sufficient fiscal space for transfers, you have to have a prudent fiscal policy. And so this is the second point that I would like to make, because you need the necessary fiscal room. And this is quite apart from what happens at the very top. But my final point, let me go back to what I said at the beginning of our presentation, and also at the end. The real answers for inequality have to do with structural policies, even more than tax policies, because structural policies address the sources of inequality at the core, you know, at the beginning, if you like, ex ante, whereas tax policies can only correct some of the impact ex post.
Claudio, let me also thank you for your very interesting presentation. I would like to focus on one of the topics you discussed, which is the different trade-offs that arise from the perspective of monetary policy when dealing with inequality. We know that bringing inflation under control, as you said, may cause a recession, and this has a short-term cost in terms of rising inequality. But this undesired effect of anti-inflationary policy, which is generally present in advanced economies, and as you said, you distinguish the case of advanced economy from the case of certain emerging economies, in which a rising interest rate not only tends to decelerate inflation by inducing real exchange rate appreciation, but also has positive effects, at least short-term positive effects in terms of decreasing inequality due to the effect on the wage share and output expansion. So it seems that for this second case of economists, the issue would be the long-term sustainability of this process, of this inflation and expansion and improvement of equality. So I would like to ask you, from your perspective, what is the role of, well, you mentioned the potential role of macroprudential policies, and in particular, capital flow management policies in preventing this kind of disruptions that may lead to an increase in long-run inequality.
Yeah. Well, I think you're hitting the nail on the head. You can have, it is indeed the case that some type of recessions can be avoided when you're bringing inflation down, if you have a credible exchange rate stabilization program and so on. And indeed, one of the reasons, as I briefly alluded to in my presentation before, is the fact that if you have a credible regime, you get a lot of foreign capital, gross capital flows, going back to what you were saying before, gross capital flows into the country, and that generates a credit boom. So the credit boom is one of the possible sources of financial recessions further down the road. And indeed, one way of trying to mitigate that credit expansion is by using macroprudential measures. I would say that capital flow management measures, I would think of them as a policy of last resort once you have exhausted the other instruments at your disposal. And I think it's important to keep them very, very focused on the sources of financial instability, financial expansion, the buildup of financial imbalances. Having said that, as we say, or I've said in a number of my previous writings, I think prudential policy can go only part of the way. It cannot go the whole way. I think that if you look at across a number of countries that have used, even those that have used macroprudential policy very energetically, you will see that the sign of financial imbalances can still be there. Rates of expansion of credit and asset prices beyond thresholds that typically indicate that there could be problems down the road. And that's partly because I think that many of the macroprudential tools, there are differences between them, are better at ensuring that the financial system is resilient if you have a bust, as opposed to being very effective in constraining the financial boom in the first place. Now, as I said, there are differences. Loan-to-value ratios, debt-to-income ratios are more effective at constraining the expansion that, say, increases in the capital requirements of banks. So prudential policy is only part of the answer. I think it is important also to use fiscal policy in that context, because financial booms tend to flatter the fiscal accounts. That's partly because output is growing beyond potential, and it's partly because these financial booms tend to be revenue rich. So I take, for example, the cases of Ireland and Spain before the great financial crisis. What you had before that was that the fiscal account adjusted for the cycle, the way they adjusted it for the cycle at the time, seemed to be very conservative on surplus. You had the debt to GDP ratio actually falling over time, but that didn't prevent a financial crisis to lead to a huge fiscal problem. So you need macroprudential policy, you need fiscal policy, and where you can, I think there is also a role for monetary policy. So I think that this is basically what we mean by a macrofinancial stability framework.
Regarding the role of monetary policy in front of inequality, you have shown that monetary policy is not useful to address income inequality, but if monetary policy increases inflation, then monetary policy may worsen the original situation of inequality. Too low interest rate for a long time might trigger bubbles and financial crisis. Too high interest rate also for a long time may produce recession and financial crisis. How do you think all these stylized facts regarding this relationship between income inequality and macro could be addressed in macro models, for example, DSG, stock flows, consistent models? How, in order to analyze monetary policy, how can this could be introduced in the standard inflation targeting framework? And finally, we have been working about this relation, this feedback effect of inequality on macro policy. Do you think it's possible to incorporate the feedback of inequality on aggregate demand, on the rate of growth, and on employment?
Well, that's a very ambitious objective, I have to say. First of all, I mean, let's start in a slightly more modest way. There is a strand of new Keynesian models that, and this is getting a little bit technical, but that basically have heterogeneous agents. And in there, you can actually incorporate aspects of inequality. Now, what I would not like people to draw from those models, and this is the danger of playing around too much with technical things without keeping the necessary perspective, is the fact that, draw the conclusion that then monetary policy should have somehow target inequality. I think that because it's an ill-suited instrument for that, that would be quite dangerous, because you would have to use the tools in a particular direction for quite long, and then all you're going to do is to create havoc with the real economy. Now, the other thing that I would say is that there are ways in which inequality can, for instance, tend to lead to also financial crisis, which I didn't cover in my presentation, but they have to do more with the political economy aspects. For example, some people have argued that the strong support in some countries for having people giving access to people to housing in general, so that they could borrow more, was one factor that actually led to the great financial crisis. And one reason why there was this strong support to try to make housing more accessible, but unfortunately through borrowing, was because, of course, wages were not rising sufficiently. And the fact that wages were not rising sufficiently effectively means that there was a tendency for inequality to rise. So there can be a link between inequality and longer-term macroeconomic outcomes, such as financial crisis. But these are the kinds of things that you cannot really capture in models.
Claudio, thank you very much again for your presentation and this very interesting discussion. We are very happy to have you in our annual conference.
Well, thank you very much for having me.